Hey everyone, welcome back to Corporate Decoder, the place where we get to the bottom of what these corporate filings really mean. And let's just say this next one might have us looking at how some companies reward their top brass and how they're handling their finances. So buckle up because we're diving into RGC Resources Incorporated's latest proxy statement. It's a pretty dense document, but we're going to pull out the juicy bits for you, focusing on what actually matters to the business and its shareholders. And hey, if you like getting these kinds of straight up insights from official reports, make sure you hit that subscribe button. We also have a Discord community where we break down more of these things, and you can find the link in the description below. First off, this is basically an invitation to their annual shareholder meeting coming up in January 2026. It lays out the big topics they plan to discuss and vote on. Three main things are on the agenda: electing new directors, deciding if their auditor Deloitte and Touch should keep their auditing job for the next year, and then a couple of other important votes about company stock and executive pay that we will definitely dig into. And they are asking shareholders to approve an additional 50,000 shares for their stock bonus plan, which sounds like a way to keep rewarding employees. Now, let's talk about the leadership team. They are electing 3 new Class B directors. 2 current directors, Mrs. Nancy Howell AG and Mr. J. Alan Lehman, are retiring. They've served many years and are stepping down, which is pretty normal. The company is also moving to have 9 directors instead of 10. So they want you to vote for Jacqueline L. Archer, Frank Russell Ellett, and Robert B. Johnston to fill those spots. They've also given us a rundown on why each of these candidates is a good pick. For example, Jacqueline L. Archer has a lot of experience running a large beverage distribution company and also worked in investment banking. Frank Russell Ellett is leading a big multi-state truck dealership and has experience on other boards. Robert B. Johnston is an executive at the Intertech Group and has served on several public company boards, including some utility ones. Overall, they seem to be bringing in people with solid business and finance backgrounds. Next up, they are asking you to rubber stamp their choice of Deloitte and Touch LLP as their independent auditors for the fiscal year ending the 30th of September 2026. This is pretty standard stuff, but it is important because these are the folks who check if the company's financial reports are accurate and honest. The company's audit committee approves this, but they're asking for shareholder approval as well. This proposal is about authorizing more shares for their stock bonus plan. They've awarded a decent number of shares to non-officer employees in the past few years, and they're running low on shares available for this plan. So they're asking for an additional 50,000 shares to keep this bonus plan going. It is a way to incentivize employees by giving them a piece of the company. This is the say, on-pay vote, shareholders get to give an advisory opinion on how the company is paying its top executives. The company emphasizes that this vote isn't binding, but they do say they listen to shareholder feedback. They explain their compensation program is designed to attract good talent, reward performance, and align executive interests with those of shareholders, often using restricted stock and linking pay to company performance and earnings. Here we get details about the directors themselves. They've broken down the board into 3 classes A, B, and C, with staggered 3-year terms. We see some familiar names from the director election proposal, like Jacqueline L. Archer, Robert B. Johnston, and Frank Russell Ellett is also nominated for a Class B director spot expiring in 2026, which they recommend you vote for. They also talk about Abney S. Boxley III and Jacqueline L. Archer being audit committee financial experts, which means they have a deep understanding of financial reporting. The report also details the responsibilities of their main committees: compensation, audit, and governance, and nominating. The audit committee, for instance, is responsible for overseeing the company's financial statements and its relationship with the independent auditor. The compensation committee oversees executive and director pay, and the governance committee deals with board composition and corporate governance matters, including environmental, social, and governance, or ESG issues. Now, how are these directors compensated? They get an annual retainer and extra fees for being committee chairs. It looks like the annual retainer is around $52,800, with additional amounts for being board chair or an audit committee chair. Plus, there is a whole system where at least 40% of their annual retainer fee is paid in company stock, which is called restricted stock. This is a way to make sure directors have skin in the game and are invested in the company's success. Some directors, like Nancy Howell AG, Jacqueline L. Archer, Abney S. Boxley III, and John B. Williamson III, chose to receive 100% of their fees in this restricted stock in fiscal year 2025. This section is all about the top brass, the executive officers. We see names like Paul W. Nestor, who is the president and CEO, Lawrence T. Oliver, senior vice president of regulatory and external affairs, Timothy J. Mulvaney, vice president, treasurer, and CFO. and a few others with VP titles. They list their roles and how long they've been in those positions, giving us a look at the company's management structure. This is where we see who actually owns the company's stock. Most of the directors and officers own shares, but typically less than 1%. Paul W. Nestor, the CEO, owns about 1.2%, and John B. Williamson III, the chairman, owns about 1.7%. There is also a significant shareholder listed as Anita G. Zucker, who owns a notable 12.8%, and then there are investment advisors also listed as owning a chunk of shares. It is good to see the leadership has some ownership, but the majority is spread out or held by a few large parties. This is the meat and potatoes of executive compensation. The company states its compensation philosophy is all about creating shareholder value by attracting and keeping good people, rewarding performance, and fostering an ownership culture. They highlight that their net income for 2025 was $13.3 million, and they've increased their annual cash dividend every year since 2004, which is a positive sign of consistent performance. The named executive officers for 2025 are Paul W. Nestor, the CEO Timothy J. Mulvaney, and Lawrence T. Oliver. They explain how the compensation committee determines pay and that the CEO is involved in recommending pay for other executives. Their principles are to pay competitively, pay for performance, and create that ownership culture, often using restricted stock and linking pay to earnings targets. Now, let's look at the actual numbers for 2025. CEO Paul W. Nestor's total compensation was over $1 million, including a salary of about $467,000, and the rest coming from stock awards and other incentive pay, Timothy J. Mulvaney and Lawrence T. Oliver also had total compensations in the $500,000 to $600,000 range. It seems like a significant portion of their pay is in stock awards, which, as they mentioned, is to align their interests with shareholders. For example, in 2025, Mr. Nestor received stock awards valued at $288,225. The company is also paying a portion of these bonuses in restricted stock, which vests over time, meaning executives only fully own it after a certain period or if they meet specific performance goals. This table shows the incentives awarded for 2025 performance that will be paid out. For Mr. Nestor, his target cash bonus was around $165,000, but he actually received over $184,000, which is 1/12% of his target. For equity, his target was $189,000, and he received $288,225, hitting 153% of his target. Similarly, Mulvaney and Oliver also exceeded their targets for both cash and equity incentives. This shows the company performance was strong enough to trigger higher payouts based on their performance metrics. This table shows stock options that are still available for executives to exercise. For Lawrence T. Oliver, he has a total of 13,000 unexercised options with various exercise prices. These are essentially rights to buy stock at a set price in the future. Here is a really interesting one. The CEO pay ratio for 2025, the company reports that the median employee's total annual compensation was about $90,935. Mr. Nestor's total compensation was $1,014,851. This means the CEO makes about 11 times what the median employee makes. They mention that this ratio might not be directly comparable to other companies due to different calculation methods, but it gives you a concrete number to think about. This table is a crucial one. It compares the total reported compensation of the CEO and other named executive officers, alongside the company's net income and a measure of shareholder return. In 2025, CEO Nestor's compensation was $1,014,851. And compensation actually paid was slightly higher at $1,022,411. Net income was a healthy $13.3 million. The value of an initial $100 investment made at the start of 2023 had grown to $120.05 by the end of 25, showing some positive stock performance over those 3 years. Looking at the numbers, there is a general correlation between good net income years and higher executive compensation, especially when looking at the compensation actually paid, which adjusts for certain accounting rules. For instance, 2025 saw strong net income and higher compensation, while 2024 also had solid net income and higher executive pay. It suggests their pay programs are indeed tied to financial results, which is what shareholders want to see. Looking ahead, they've set the salaries and incentive plans for 2026. The CEO's base salary is going up to $486,750, a 3% increase. Other executives are also seeing modest salary bumps of around 3 to 10%. Their incentive plans for 2026 are also laid out, with cash incentives being 50% tied to individual performance and 50% to earnings, and equity incentives directly linked to earnings results. For instance, for 2026, Mr. Nestor has a target cash incentive of $170,336 and a target equity incentive of $194,670, with potential maximums much higher. This section details severance agreements, particularly for situations like a change in control, which means a merger or acquisition. The CEO, Paul W. Nestor, has an agreement that if he is terminated without cause within 2 years of a change in control, he'll receive twice his annual compensation as a lump sum, plus continued benefits for 2 years. Identical agreements are in place for Timothy J. Mulvaney and Lawrence T. Oliver. This is pretty standard for executive retention in case of major company changes, ensuring they are compensated even if their roles become redundant. Here we see the potential payout under those change in control agreements. For Paul W. Nestor, this could be around $1.7 million in cash and other benefits. For Timothy J. Mulvaney, it is about $825,000. And for Lawrence T. Oliver, it is nearly $900,000. These figures are based on previous year's compensation and the value of unvested stock awards. It's a substantial amount reflecting the value placed on retaining these key executives and providing them with security in the event of a company sale or merger. This is the committee that oversees executive pay, and they've reviewed the compensation discussion and analysis section. They confirm their role in setting goals, evaluating performance, and recommending compensation and equity grants to the board. This committee is responsible for director nominations and overall governance. They are the ones recommending the new directors we talked about earlier and that the board has approved. They focus on things like identifying qualified candidates, ensuring director independence, and overseeing ESG matters. The audit committee is responsible for overseeing the company's financial reporting and its relationship with its auditors. They met with management and Deloitte to review financial statements and internal controls. They confirmed Deloitte's independence and that any non-audit services didn't compromise that. They also provided a breakdown of fees billed by Deloitte. For 2025, audit fees were $427,500 and all other fees were about $20,000. This indicates a significant portion of the auditor's work is on the actual audit itself, which is good. This part outlines how shareholders can submit proposals for future meetings, what information they need to include, and how to communicate with the board of directors. It sets deadlines for getting proposals in to be considered for inclusion in the proxy statement. Alright, let's zoom out and look at the bigger picture for RGC Resources, Incorporated based on this filing. On the positive side, the company seems to have a pretty consistent approach to executive and director compensation, with a clear emphasis on aligning pay with performance through stock awards and incentives tied to earnings. The pay ratio, while showing a significant gap between the CEO and the median employee, is within a range that is not massively out of line in corporate America, and the fact that they are reporting it and that their pay seems correlated with solid net income and shareholder returns in the pay versus performance table is a good sign. The dividend increases since 2004 also point to financial stability and a shareholder-friendly approach. The company is actively working on environmental initiatives, evidenced by their renewable natural gas facility and commitment to reducing methane emissions with One Future. However, there are always things to watch. While the company does have severance agreements in place for executives, the payouts can be substantial in the event of a change in control, and shareholders might want to keep an eye on how those are structured and if they offer excessive golden parachutes. Also, the continuous need to authorize more shares for bonus plans could, over the very long term, dilute existing shareholders if not managed carefully. The fact that a significant portion of stock ownership is concentrated with a few individuals and investment groups, while common, means that large shareholders can have a considerable influence on company decisions. Overall, RGC Resources appears to be a company with a stable, if not spectacular, dividend history, and a compensation structure that attempts to tie executive rewards to company performance. They are also making efforts in the ESG space. The core business of providing energy services likely offers consistent revenue streams, but growth opportunities would depend on market conditions and their strategic investments. What do you think about their executive compensation structure and their financial performance this year? Let us know your thoughts in the comments below. If you found this breakdown useful, smashing that like button really helps us out. And don't forget to subscribe for more deep dives into the corporate world. And again, join us on Discord for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.